The current headlines describe silver as volatile, speculative, and driven by short-term trading flows, with most coverage focusing narrowly on daily price movements, technical resistance levels, or central bank commentary that treats the metal as a peripheral asset rather than a strategic one. Yet beneath the surface of this framing, a far more consequential test is underway, one that does not revolve around sentiment or chart patterns, but around the physical limits of a global system that has quietly depended on excess inventory and geographic imbalance for decades. The repeated testing of the $100 level in silver, particularly through Asian physical markets, is not a curiosity or an outlier, but a signal that long-standing assumptions about where price is discovered, how supply responds, and who ultimately controls market equilibrium are being challenged in real time. By the end of this analysis, it will be clear that what appears to be a pricing anomaly is in fact the manifestation of a structural strain between Western paper-based systems and Eastern physical demand, and the unresolved question is no longer whether this tension exists, but how long it can be contained before it forces a repricing that few participants are prepared for. For decades, the global silver market has been understood as a relatively efficient, integrated system in which futures exchanges, bullion banks, refiners, and industrial consumers interacted through a common reference price that allowed supply and demand to balance with minimal friction. The prevailing assumption has been that liquidity in Western exchanges ensures stability, that inventories can be mobilized when needed, and that price signals transmitted through paper markets ultimately reflect underlying physical reality. This belief has been reinforced by long periods of subdued volatility, ample above-ground stocks, and a financial architecture capable of absorbing localized disruptions without forcing global dislocation. Within this framework, regional premiums have been treated as temporary distortions, arbitraged away by market participants incentivized to equalize price differences across geographies. However, this model depends on conditions that are no longer reliably present, particularly the assumption that physical supply remains elastic and readily available to meet rising demand. Western vault systems, which historically functioned as buffers absorbing shocks and smoothing flows, have seen persistent drawdowns that are often obscured by aggregate reporting and paper offsets. At the same time, industrial consumption has become both more concentrated and more inelastic, with critical sectors such as solar manufacturing, electrification, and advanced electronics requiring uninterrupted access to silver inputs regardless of price fluctuations. These pressures do not immediately destabilize markets, but they erode the margin of safety that once allowed paper mechanisms to dominate price discovery, creating a growing divergence between nominal prices and transactional reality. The visible symptom of this divergence is the repeated inability of Western markets to suppress price advances driven by Eastern demand, despite significant paper selling and algorithmic interventions designed to cap rallies. Each attempt to test higher price levels exposes thinner liquidity, slower replenishment, and a growing reluctance among holders of physical metal to part with inventory at prices that fail to reflect replacement costs. While official narratives emphasize resilience and orderly functioning, the persistence of elevated premiums in Asia suggests that stress is not episodic, but cumulative, building quietly until the system's capacity to absorb it diminishes. This is not the behavior of a market experiencing temporary imbalance, but of one undergoing a structural transition in how value is assigned and defended. History offers a useful lens through which to understand this process, particularly during periods when confidence in price-setting mechanisms eroded faster than institutions could adapt. Comparable episodes have occurred when commodity markets transitioned from surplus to scarcity, often following extended phases of financialization that obscured physical constraints. In these moments, authorities and market makers initially relied on familiar tools, increased paper issuance, regulatory reassurance, and coordinated messaging to stabilize expectations and discourage hoarding. These measures were often effective in the short term, delaying price discovery and preserving the appearance of control, but they also intensified the eventual adjustment by allowing imbalances to grow unchecked beneath the surface. One such episode unfolded during previous commodity shortages in which regional demand centers exerted disproportionate influence over supply chains, gradually shifting pricing power away from traditional financial hubs. As confidence weakened, arbitrage mechanisms that once enforced uniform pricing began to fail, not because opportunities disappeared, but because the physical means to exploit them became constrained. Transport bottlenecks, inventory depletion, and rising geopolitical friction limited the ability of intermediaries to move material freely, transforming what were once profitable trades into logistical and financial risks. The result was a delayed but abrupt repricing, driven not by speculation, but by the necessity of rationing scarce supply through higher prices. What made these episodes particularly instructive was the speed with which sentiment shifted once the underlying constraints became undeniable. Markets that had appeared stable suddenly exhibited gap moves, forced liquidations, and rapid reassessments of fair value, as participants realized that paper representations could not substitute for physical availability. The parallels to the present silver market are increasingly difficult to ignore, especially as Eastern demand continues to assert itself through sustained premiums and direct procurement strategies that bypass traditional Western intermediaries. The same dynamics that once allowed price suppression are now revealing their limits, suggesting that the conditions for a similar transition may already be forming. At this stage, the key question is not whether silver can reach $100, but whether the systems designed to manage and moderate price discovery are capable of accommodating the forces pushing it there without triggering broader disruption. The early signs of strain are visible to those willing to look beyond surface-level narratives, and the patterns observed in past transitions suggest that once a critical threshold is crossed, adjustments tend to occur rapidly rather than gradually. The relevance of these historical precedents lies not in their exact outcomes, but in the mechanisms through which confidence deteriorates and control shifts, mechanisms that appear increasingly active in today's market environment. The historical pattern becomes clearer when examined through the lens of markets that depended on trust-based liquidity rather than enforceable physical settlement, because in each case the breakdown did not begin with an obvious failure, but with a gradual loss of confidence in the mechanisms that were supposed to guarantee balance. In earlier commodity cycles, where financial instruments dominated pricing, the initial warning signs were often dismissed as regional anomalies or temporary dislocations, while institutions reassured participants that inventories were sufficient and that arbitrage would restore equilibrium. Yet as physical material quietly migrated toward the highest marginal buyer, the paper markets that once appeared deep and resilient began to thin, exposing the fragility beneath the surface. By the time prices adjusted decisively, the adjustment was no longer a choice made by policymakers or market makers, but a necessity imposed by depleted buffers and irreversible flows. A defining characteristic of those episodes was the delay between the recognition of stress and the acknowledgement of its implications. Authorities frequently underestimated the speed at which physical constraints could overwhelm financial abstractions, particularly when those constraints were amplified by geopolitical realignments or industrial policy shifts. Efforts to stabilize markets through communication strategies and incremental interventions often succeeded only in compressing volatility temporarily, while allowing underlying imbalances to worsen. When confidence finally broke, it did so abruptly, producing sharp repricing events that redefined market structure for years to come. The lesson from these precedents is not that such outcomes are inevitable, but that systems reliant on surplus capacity and global cooperation are especially vulnerable when those conditions erode simultaneously. When these historical dynamics are compared with the present silver market, a recognizable pattern begins to emerge, one rooted in the interaction between trust, liquidity, and physical availability. For much of the modern era, silver pricing has depended on the assumption that futures markets accurately represent supply and demand, even though the vast majority of contracts never result in delivery. This arrangement functions smoothly as long as confidence in settlement remains high and inventories are ample enough to discourage delivery requests. However, when participants increasingly seek physical metal rather than financial exposure, the balance shifts, and the system must confront its own limits. Early signals of this shift are often misinterpreted as speculative excess, rather than as rational responses to perceived scarcity. The recurring pattern in such transitions is that early warnings are ignored because they conflict with established narratives of stability and control. Market participants accustomed to abundant liquidity struggle to recognize the significance of rising premiums, delivery delays, or localized shortages, viewing them as noise rather than indicators of systemic change. Yet these signals tend to intensify rather than dissipate, gradually forcing a reevaluation of assumptions that once seemed unassailable. The silver market's repeated testing of higher price levels, driven by sustained Eastern demand, fits this trajectory, raising the question of whether the system is approaching the point at which confidence in paper mechanisms can no longer offset physical reality. What distinguishes the current environment from past episodes, however, is the convergence of constraints that significantly narrow the range of possible outcomes. Unlike earlier cycles, when inventories could be rebuilt and supply chains expanded with relative ease, today's silver market faces structural limitations that reduce flexibility. Mining output has struggled to grow meaningfully despite higher prices, recycling flows remain constrained, and environmental and regulatory pressures limit the speed at which new supply can be brought online. At the same time, industrial demand has become both larger and less discretionary, embedded in technologies and infrastructure that governments and corporations consider strategically essential. Geopolitical fragmentation further compounds these challenges, as the global economy shifts away from seamless integration toward regional blocs with competing priorities. Eastern economies, particularly those driving demand growth, are increasingly willing to secure resources directly rather than rely on global markets governed by Western financial institutions. This shift alters the calculus of price discovery because it prioritizes physical procurement over financial optimization. Western vaults, long treated as neutral reservoirs supporting global liquidity, now find themselves functioning as supply sources for regions that no longer accept Western price signals as authoritative. Policy constraints also play a critical role in differentiating the present situation from historical analogs. Central banks and regulators operate within tighter boundaries, constrained by elevated debt levels, inflation sensitivity, and political polarization. The tools once used to suppress volatility or incentivize supply expansion carry greater risks, limiting the willingness of authorities to intervene decisively. As a result, market responses are increasingly reactive rather than preemptive, addressing symptoms rather than causes, and allowing structural pressures to accumulate. This convergence of depleted buffers, rigid supply, industrial dependence, and geopolitical realignment creates an environment in which conventional solutions lose effectiveness. Efforts to stabilize prices through paper mechanisms face diminishing returns when physical metal is consistently drawn toward higher-paying markets. The implication is not that control has vanished entirely, but that it has become conditional, dependent on cooperation and surplus that no longer exist in sufficient measure. As these constraints tighten, the system approaches a phase in which outcomes are determined less by intent and more by necessity. The immediate consequence of this dynamic is a narrowing window in which price discovery can remain gradual and orderly. As the silver market continues to test higher levels, the ability of Western systems to supply metal at suppressed prices diminishes, increasing the likelihood of abrupt adjustments. The question confronting market participants is no longer whether pressures will converge, but when and under what catalyst they will do so. This unresolved tension sets the stage for the near-term period in which structural forces, rather than policy assurances, are likely to dictate the trajectory of silver prices. The near-term pressure window now forming is defined less by speculative enthusiasm than by the convergence of constraints that limit the system's capacity to respond smoothly. As physical demand from Eastern markets remains elevated and Western inventories continue to thin, even modest catalysts have the potential to accelerate adjustment. Delivery cycles, industrial restocking schedules, and year-end and early-year capital reallocations concentrate stress into compressed timeframes, reducing the margin for delay or gradualism. In such conditions, market behavior becomes increasingly sensitive to signals that would otherwise be absorbed without incident, and price movements begin to reflect urgency rather than expectation. The competing stakeholders in this environment are not evenly matched, with industrial consumers prioritizing continuity at almost any cost, financial intermediaries attempting to manage exposure without exacerbating volatility, and policymakers constrained by broader economic considerations that limit their willingness to intervene forcefully. As these pressures intensify, responses are more likely to be reactive than controlled, shaped by immediate necessity rather than long-term strategy. When physical supply tightens further, price must rise to ration demand, regardless of official comfort levels or narrative preferences. This dynamic transforms the testing of $100 silver from a symbolic threshold into a functional one, representing the price at which flows slow enough to stabilize availability. Whether this stabilization occurs smoothly or abruptly depends on how quickly remaining buffers are exhausted and on whether confidence in paper settlement persists long enough to prevent a scramble for physical metal. The strongest unresolved tension lies in the possibility that once a critical point is reached, adjustment may occur in discrete jumps rather than continuous increments, challenging assumptions about orderly markets. Much of the public discourse surrounding silver seeks to reassure participants that such outcomes are unlikely, emphasizing the depth of futures markets, the flexibility of financial instruments, and the historical tendency of prices to revert after sharp moves. These arguments, while not without merit, often conflate narrative stability with structural resilience, assuming that confidence alone can substitute for physical sufficiency. By focusing on headline inventories or aggregate contract volumes, they obscure the distributional reality of where metal resides, who controls it, and under what conditions it is willing to move. In doing so, they underestimate the significance of persistent regional premiums and the willingness of industrial buyers to bypass traditional channels in pursuit of security. Another common misconception is that higher prices will quickly elicit new supply, restoring balance and capping further advances. This view overlooks the time horizons and constraints inherent in mining and refining, as well as the strategic motivations that drive current demand. Even where potential supply exists, it cannot be mobilized instantaneously, and in some cases, may already be committed through long-term agreements or state-directed procurement. The result is a lag between price signals and physical response that allows pressure to build, undermining the assumption that markets will self-correct before stress becomes acute. The core issue revealed through this analysis is not a single price level or event, but the gradual reconfiguration of how value is determined in a market where physical realities are asserting themselves over financial abstractions. The testing of $100 silver reflects a broader process in which Eastern demand challenges Western pricing authority, forcing a reassessment of long-held assumptions about liquidity, control, and resilience. This process is ongoing, shaped by structural forces that evolve over months and years, rather than days, and its implications extend beyond silver to other commodities and assets, governed by similar dynamics. As this situation continues to unfold, two questions merit careful consideration. How long can paper-based systems maintain credibility when physical availability becomes increasingly contested? And what happens to price discovery when the highest marginal buyer no longer accepts traditional benchmarks? These are not academic concerns, but practical ones that will shape market behavior and policy responses in the period ahead. For continued analysis of developments that tend to surface only after they have already altered the landscape, consider subscribing to stay informed as these structural shifts progress toward their next inflection point. What follows logically from the dynamics already outlined is a deeper shift in behavior among market participants that is not yet visible in headline data, but is already influencing decisions behind the scenes. As silver continues to probe higher price territory, the incentive structure governing producers, refiners, dealers, and end users begins to change in subtle but decisive ways. When price volatility increases in an environment of constrained supply, participants who would normally act as stabilizers instead become conservators, prioritizing inventory retention over turnover. This behavioral shift reduces effective liquidity even further, amplifying the impact of incremental demand and making price discovery increasingly discontinuous. In such conditions, the market ceases to function as a smooth clearing mechanism and instead behaves like a rationing system, where price must rise sharply to force marginal demand out. This is particularly relevant when examining the role of intermediaries, who have historically bridged the gap between Western financial markets and Eastern physical consumption. These actors operate on thin margins and rely on predictable flows to manage risk. When price differentials persist and physical availability tightens, their capacity to intermediate diminishes, not because opportunity disappears, but because exposure becomes asymmetric. The risk of being unable to replace metal at any price introduces a nonlinear cost that conventional hedging cannot offset. As a result, these intermediaries reduce activity, withdraw offers, or reprice aggressively, contributing to the appearance of sudden scarcity even when aggregate supply statistics suggest adequacy. At the institutional level, this environment complicates policy signaling and market management. Authorities accustomed to influencing expectations through communication face a credibility gap when physical outcomes diverge persistently from official benchmarks. Reassurances that markets are functioning normally lose effectiveness when delivery delays lengthen, premiums remain elevated, and industrial users signal urgency rather than optionality. The disconnect between narrative and experience erodes trust incrementally until participants begin to discount official commentary altogether. At that point, policy tools designed to stabilize markets may arrive too late or operate through channels no longer regarded as authoritative. The implications extend beyond price alone, touching on broader questions of monetary confidence and resource security. Silver occupies a unique position as both an industrial input and a monetary metal, linking real economy demand with perceptions of currency stability. As Eastern buyers demonstrate willingness to pay substantially higher prices to secure supply, they implicitly signal a preference for tangible assets over financial claims. This preference, once established, tends to persist, reinforcing demand even as prices rise and reducing the likelihood of rapid mean reversion. For Western markets, this represents not merely a pricing challenge, but a strategic one, as reliance on paper instruments becomes increasingly misaligned with global procurement realities. Looking forward, the path from testing to acceptance of higher price levels is rarely linear. Periods of consolidation, pullbacks, and renewed volatility are to be expected, particularly as participants reassess risk and adjust exposure. However, the structural forces at work suggest that such pauses function less as reversals and more as recalibration points, allowing the system to absorb information before resuming adjustment. Each successful defense of elevated price zones reinforces the perception that prior benchmarks no longer reflect equilibrium, gradually shifting expectations upward. In this context, the question is not whether silver will experience turbulence as it approaches and potentially exceeds $100, but whether the market infrastructure can adapt without broader disruption. The answer depends on factors largely outside the control of any single actor, including the pace of industrial expansion, the evolution of geopolitical alignments, and the willingness of holders to release physical metal into circulation. These variables interact in complex ways, making precise forecasting difficult, but they share a common implication: that stability achieved through suppression is inherently temporary when underlying scarcity persists. As the analysis comes full circle, it becomes clear that the testing of $100 silver is not an endpoint, but a waypoint in a longer process of adjustment. Western vaults struggling to keep up with Eastern demand reflect a deeper reordering of priorities and power within the global market. Whether this transition unfolds gradually or through sharper dislocations will depend on how quickly remaining buffers are exhausted and how decisively participants respond to emerging constraints. What is certain is that the forces driving this shift are structural rather than speculative, and once set in motion, they tend to resolve not through reassurance, but through repricing.